This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Black swans are blindsides, events like COVID or 9/11, but gray swans are those that seemed unlikely but could still happen. Well, those are starting to emerge from the shadows in greater numbers. Up next, let's discuss what's been a very eventful week and frame the market and economic backdrop as we ease here into 2026. Stay tuned. Welcome on board another edition of our Wise Investor Group podcast. Simon Hamilton here, Managing Director at the Wise Investor Group of Raymond James. Glad to be with you. Happy New Year. Hope you had a safe, relaxing, and joyous holiday season. And no rest for the weary. Here we go. It's been a very eventful week to start the year. I made a reference in my opening to the idea of gray swans, right? We all know what black swans are. Black swans are events that come out of nowhere and blindside either the markets or society as a whole, right? COVID, 9/11, some of these things that weren't necessarily on anyone's radar at the time. But gray swans are different. Gray swans, I actually looked up, I confess, an AI definition of gray swan. Quote, significant low probability event that are conceptually possible and known to have major impacts. Unlike unpredictable black swans, but whose exact timing, duration, and full consequences remain uncertain. So we're starting to get some gray swans, right? Things that were loosely talked about, like us taking over Greenland and some of the things that have come out of the Trump administration that people didn't really model for, right? Either conceptually or in terms of their investment positioning. But we knew in the back of our minds could be a possibility. Well, now we're starting to get some of those things, right? And remember, this is a midterm election year. So whether you love Trump or hate Trump, the reality is he wants to maintain the House, right? He wants to maintain the Senate. And he wants to do some things that he believes will put his administration and the Republicans in general in the most favorable position going into November. And by the way, I'm not saying that's the only reason why he wants to do some of these things. There are a lot of other reasons, right, which we'll get to in a minute. But the point is, I think in this type of year, you can expect some of those, again, gray swans, some of these things that were maybe loosely talked about a year ago, 6 months ago, but they're going to become more the reality. So be prepared for day-to-day volatility. We've certainly seen a lot of sector volatility to begin the year. We've seen some really big swings between healthcare and tech and financials and industrials, certainly oil, energy. We're going to see more of that going forward. But I did want to comment briefly on the Venezuela situation, which again, if I was doing this podcast a year ago, I doubt I would have talked much about Venezuela, right? But here we are. And my initial take is, and again, this is just my take. I don't know any more than you do, really, what's going to happen there. But my initial take is more of a geopolitical event than a market event, because geopolitical risk tends to be transmitted to the global markets via oil prices. That's where geopolitical events tend to be more influential. That's why whenever something happens in the Middle East, it tends to be market moving, at least for a period of time, because it could affect the oil supply. But for now, we haven't seen a lot of movement in crude oil, and I'll get to that in a minute, and therefore we have not seen a lot of movement in the markets. We had a couple good days in the S&P and the Dow, a couple bad days in the S&P and the Dow, but overall no great moves. What's going on there? Well, like with a lot of things, like you saw in Gaza, for example, it's not so much the event itself, it's the extent of the escalation or proliferation. And so in this case, well, obviously the Trump administration feels emboldened at this point. That gives, I think, them the confidence about making other moves potentially. It's one thing to talk about Venezuela. It's another thing to talk about Mexico. What happens if we bomb Mexico or take military action in Mexico? Certainly Greenland is part of that narrative. So again, it's not about so much what has happened, it's about what could happen. Again, without knowing more than you do, I really think this has mostly to do with the idea that the U.S. and with this administration is not going to tolerate external foreign influences in the Western Hemisphere. I think it's as simple as that, okay? We can talk about fentanyl and drugs, and I'm not going to say those were a ruse, but I think those were more the methodology by which the administration could justify, a regime change there, and sort of gives them the legal framework for regime change there. But the actual conceptual reason for it, philosophical reason, and maybe policy reason, is really trying to shore up this hemisphere and remove, or at least significantly reduce, the influence of China, Iran, and Russia, which was clearly the case in Venezuela, where all three of those countries were gaining influence. And I think the other thing that's going on is, and this is not unique to the U.S., China's tried to do the same thing, is controlling your own resources. Okay, the U.S., I think, wants to make sure that we have ample resources or access to the natural resources that we need not only to drive our economy, but to drive innovation. So rare earth minerals, the things that can fuel the AI revolution. We want to make sure we are not overly dependent on foreign supply chains for that. So that's kind of my take. If you look at sort of the history of conflicts like this, actually not just conflicts like this, but any conflicts. I actually saw something from Schwab this week that I thought was very interesting. It looked at the S&P 500 performance over the first 6 months of essentially every major military conflict going back to World War II, including the Korean War, Vietnam War, and less significant conflicts like the Kosovo conflict, Syrian civil war, Israel-Hamas war, most recently in 2023. And by the way, when I say less significant, I'm not trying to mitigate the impact of those things on certain people, but from a global perspective. And what the history is very interesting. The S&P was only negative 3 times over 6 months. The Syrian civil war, the S&P was down 8%, but that was in 2011, which was kind of a crappy year for the S&P in general. Russian invasion of Ukraine, S&P was negative by only 2%. But again, that was when the Fed was starting to raise rates. So I think there was other reasons. So the bottom line is, we'll see what happens. Anything could happen. But generally speaking, even the most severe, integrated, if you will, military proliferation throughout the world have generally not negatively impacted the markets. And if they have, it's really because there were other reasons, right? It wasn't solely attributable to the military action. And the other thing is, let's be honest, Venezuela is not a significant economic entity, if you will. Their global economic importance has diminished significantly over the years. In fact, in the 1970s, according to my reading, Venezuela was about 1% of global GDP, producing about 3.5 million barrels of oil a day, which is about 8% of global supply. Flash forward to today, only 0.1% of world GDP, 0.1. And they only produce 1% of global oil, which makes them the 18th largest producer in the world. So they're essentially a non-entity from an economic perspective. So that's another reason why this is more of a geopolitical event than a market event. But I will say, though, that that could change, because even though they're not a big producer, and that's largely because they haven't invested in infrastructure, all kinds of political dysfunction and spending dysfunction, but they do have the highest proven oil reserves in the world, even more so than Saudi Arabia, Canada, Kuwait, Iraq, Iran, all those countries. So there's certainly the potential for a very interesting oil supply dynamic over the next couple of years. I don't think it's going to happen right away, and that's why initially oil prices really haven't done a whole lot, right? They went up slightly one day, down slightly the next. It will be a long time before there's enough investment into the infrastructure there, either from the U.S. and companies like Chevron or elsewhere, to really drive an increase in supply. But you could see that on the horizon. So ultimately, if the administration is successful in quote-unquote managing Venezuela, we'll see what that means. But ultimately, you could see more supply come online, potentially That would be the catalyst for lower long-term oil prices. Maybe more importantly, it might give the Fed some room, right? If oil prices and gas prices by extension are not a big impact on inflation, maybe that helps to give the Fed a little bit more room to continue to be accommodative and lean a little bit more dovish in their policy. So we'll see. But those are some of the issues that we're thinking about. Again, I don't think there's anything that is really all that actionable at this point, despite some of the market volatility, but stay tuned. We'll keep you abreast of what's happening. Back to the markets, I'll sort of confess here, I'm going to be a little bit all over the place today. I thought it was just important to kind of frame the backdrop a little bit as we come into the new year. This is my first podcast I'm hosting here in 2026, so just thought I'd kind of level set a little bit. By the way, we didn't get a Santa Claus rally. You know, that gets talked a lot about in the media, that historically the last 5 trading sessions of the previous year and the first 2 trading sessions of the next year, so-called Santa Claus rally period, generally speaking, produces positive returns. And so there was a lot of expectation and maybe some disappointment that we didn't get that this year. We actually saw a negative return over that period. But if you widen the lens a little bit, this is actually the 3rd year in a row we haven't gotten a positive return. So, you know, I'm not sure how much stock I place in that. And of course, last 2 years we've had double-digit returns in the S&P, so it hasn't mattered a lick that we haven't gotten a Santa Claus rally. And really, if you, again, lengthen the lens or widen the lens, I should say, if you go all the way back to 1950, January performance actually does matter. Okay, not so much the Santa Claus period or the holiday period, if you want to put it that way. But January does tend to be influential. So strategists noted in their work that, again, going back to 1950, when you have a positive January, the rest of the first quarter is up on average 1.6%. First half of the year up 5.5%. Rest of the year 12.2%. When you have a negative January, okay, generally leads to a negative return of 0.7% over the first half and only a 2.1% return for the year. So, you know, again, I'm not going to place too much stock in that kind of stuff, but I do think if we can be on relatively firm footing over the next few weeks, that does bode well for the future. Just, you know, before I get into kind of the backdrop a little bit more, you know, as I look back on 2025, you know, I'm always talking about kind of market lessons, right? You know, what do we learn over and over again, regardless of the economic environment, regardless of the political environment? There's some sort of truisms that kind of always seem to work, right? And last year was no different. So I thought I'd just highlight maybe 6 or 7 things really briefly that I took away from last year when I was kind of thinking about and preparing for this podcast that we should just remember, just keep in the back of your minds. And of course, maybe the most obvious one is, you know, you can be a terrible market timer and still do fine. Last year was a crazy year, right? We started out pretty good, pretty well. Market dropped almost 20% in a very short period of time. People have almost forgotten that. I mean, the fact that we were going to have a good year this year was far from clear back in April and May. In fact, for many people, it was the opposite. A lot of people sold out at that time, got out of the market altogether. And then, of course, we had one of the strongest rallies coming off a 20% drawdown ever recorded. But back to the point about market timing, I mean, let's say you had loaded up in February, early March of last year. You would have been, I'm just talking, you know, hypothetically, if you had just invested in the S&P. Well, you would have been down 20% right off the bat. But guess what? You probably still would have had a 10% plus return last year. It may not have been 30 or 40%, you know, like if you had invested at the bottom. But being absolutely dead wrong on your market timing, you still had a good return. The media, many financial advisors, you know, they place way too much stock in timing. You got to get in at the right time, out at the right time. Over longer periods of time, it really doesn't matter or matters very, very little. Okay, so that's one big takeaway. Second sort of interesting takeaway, and you may not even be aware of this, is stocks are spending less time in the S&P 500. The churn is much more than it used to be. So I read a piece from Bank of America that roughly a third of the S&P 500 has been replaced since 2015. That is a lot. That is a lot of turnover. In 10 years, a third of the S&P has switched out. That much lower churn rates, 20, 30 years ago. So what does that mean? It means a couple things. One is we're seeing more technological disruption. Companies are becoming obsolete faster as technology becomes more sophisticated and grows in sophistication exponentially rather than arithmetically. But what it means from an investment standpoint is it's okay to be patient. It's okay to buy and hold. We still espouse both of those things. But buy and forget is not okay. Just thinking that, the stocks you've had or that you inherited from your parents or your grandparents that they've had for 20, 30, 40 years, some of those are going to be still okay to hold. Some of them aren't. Okay, so constant review of a portfolio is still important. Now, constant review does not mean constantly trading or churning, but it does mean constant review. Private wealth management goes way beyond picking stocks. Do you have a well-thought-out, cohesive strategy to grow, preserve, and pass along your wealth? Tune in every week as we discuss how to think about your big plans and how to become a better-informed, wise investor. Listen to us at The Wise Investor Group at raymondjames.com/The Wise Investor Group, or just find us on your favorite podcast app. Raymond James Financial Services Incorporated, member FINRA, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.
The other thing that I'm always reminded of, and I was reminded of again last year, is just because it seems like a market signal doesn't mean it is one. And what I mean by that is if you pick up the Wall Street Journal or if you read any sort of financial website, you're always seeing headlines like, hey, this indicator suggests that it's time to sell. This indicator suggests that, it's a bull market ahead. The one that I read just yesterday was, the ratio of gold to oil is at a level that suggests market caution ahead, or that we should be cautious as we look at the market going forward. What I've learned over the years and what I learned again last year is no market signal should be looked at in isolation, right? The one that people point to all the time is valuations. If you had relied just on valuations, you may have been very bearish on the market the last few years because we've been at historically stretched levels. Just looking at that without regards to profit margins and productivity and the other influences on valuations would have led you to be out of the market, underexposed to pretty good returns for the markets the last few years. Never consider one data point without considering the broad context. Another thing is, picking stocks has always been hard. That's nothing new. But holding winning stocks is very, very challenging. We all read those stories, right? If you just put $1 into Apple or Amazon or Nvidia, 20, 30 years ago, this is what you would have today. And you're like, oh man, I can't believe I sold it. And that's because holding stocks is incredibly difficult. To wit, I read something, again, I think it was Bank of America. They looked at the 20 best performing stocks over the 40 years from 1985 to 2024. Okay, the 20 stocks with the best annualized returns over 4 decades. Get this, the median maximum drawdown for those was 72%. That's for the best 20. I mean, God knows what it was for the worst 20. But for the best 20, 72% drawdown was the median. with a maximum drawdown duration from peak to trough of 2.9 years. And the median time to return to the prior peak was 4.3 years. So the best stocks that we can think of in most of our investment lifetimes have had incredible amounts of volatility and periods where the stocks look like, completely lost losers, right? So the lesson is, one, you've got to be patient. It's not easy. And, even as we saw this year, NVIDIA, right, ended up having a good year. It was only one of two Magnificent Seven stocks to outperform the S&P. They had almost a 40% drawdown in April. So just keep that in mind as we go forward. Well, I'll mention two others briefly. High valuations can be followed by years of strong returns. It was 10 years ago that Robert Shiller and others came out and said that the market's the most expensive it has ever been in terms of the cyclically adjusted price-to-earnings ratio. Well, that was 10 years ago. The S&P 500 has had double-digit annualized returns since then. Okay, so again, valuations matter. They matter a lot, but they are very poor in terms of a timing indicator. And there are reasons why sometimes valuations can move higher for a significant amount of time and maybe justify higher stock prices. The last one I'll just mention, and this is always the case, the stock market is not the economy. The economy is not the stock market. Stocks can do well even when the economy is cooling, and we certainly saw that this year. So I'll get off my high horse. Don't want to talk too much about market lessons, but these were some things that I saw last year that I have talked about. If you've been listening to me for the last 20 plus years, I've talked about these things ad infinitum, but they rang true again. So keep those in mind. All right, let's transition a little bit. As promised, I want to talk a little bit about the lay of the land. And I'm not doing this with the sense of trying to make any predictions here about 2026, but just kind of frame the landscape a little bit. Full disclosure, I'm not going to get really into individual stocks today. I will, and I think Chase Hinderstein will as well, the next few weeks, because we're going to start getting the fourth quarter earnings. We start getting earnings from the banks as soon as next week. So we'll have more company-specific news to share with you. But for the time being, one of the big reasons, of course, why the market did well last year, is because we never went into recession. I mentioned a few minutes ago that the outcome for the year in April and May was far from clear, right? In fact, when Liberation Day hit and we got, the wave of tariffs and promised tariffs, almost every economist that I've ever read ratcheted their odds for recession significantly. J.P. Morgan, I think, was the first one. I saved a quote. They think that, this is from April 4th, they think that the economy will enter a recession in the back half of 2025 as the impact of President Trump tariffs take hold in the economy. But instead, we got 3.8% GDP in Q2, 4.2% in Q3. Haven't gotten the Q4 data yet. But still, no evidence of recession brings the U.S. economic expansion up to 65 months. And a lot of that has to do with the fact that tariffs have not worked in the way that some people thought they were going to work, right? Our friends at Strategas, they did a lot of good work on this. And they thought at the time that tariffs had more of a deflationary impact than an inflationary impact. And I will give them credit. They've been kind of spot on that. Now, that's not to say that tariffs can't be more inflationary going forward. They've only been in place in some cases of 6-7 months. But for now, what we have seen is a cooling labor market, which and inflation that has actually come down. So we got a much different economic reaction to tariffs than what was expected. And it looks more like a one-time shift in price level than runaway inflation. But it has led, I think, in many ways to some cooling in the economy. And there are other influences on that. Certainly AI, right, has eliminated a lot of jobs. But I do feel that a lot of corporate decision makers, hiring departments have been sitting on their hands, right, trying to see what's going to happen, waiting to see what's going to happen, and trying to defend, quite frankly, profit margins, right? So it's not that tariffs haven't impacted. It's just that they haven't been kind of delivered to the economic data in the way that people thought they were going to be delivered, right? Companies have absorbed some of those costs and maybe cut costs and slowed down hiring decisions to offset some of those costs. But it's certainly a confusing labor market. And I mention that because of all the economic data that's out there, the labor data, the employment data is probably the most significant. It's the set of data I would pay the most attention to. And of course, it was problematized by the fact that we had the government shutdown, Trump removed. Of course, the BLS secretary was responsible for kind of delivering the data. So there's a lot of opaqueness, if that's a word, less transparency maybe in the data than there was 6, 7, 8 months ago. But on the face of it, if you trust the data, look at the latest non-farm payroll report. The U.S. has added only 10,000 jobs a month over the past 4 months. That's the fewest since the 2020 COVID-induced recession. And in the past 50 years, this type of weakness has preceded a recession and a spike in the unemployment rate 100% of the time. So that's kind of the headline. However, there is some thought that maybe it is different this time. So for one, I mentioned the AI threat, but the bigger thing is immigration, right? Lower immigration levels may be the primary factor in leading to a rapid decline in jobs. That came from a Fed analysis that found half of the payroll decline can be attributed to reduced immigration. That was the Minnesota Fed. So what about the other half? Well, there's debate about that as well. Even Chairman Powell said that the U.S. had been overstating jobs over the last 5 years, up to 60,000 a month. Okay, and it's a little more nuanced than that. But perhaps some of the decline recently is merely due to reflecting the reality using previous models that were overinflating the job market. That could be true as well. But bottom line is we are seeing cooling, right? U.S. unemployment rate's up to 4.6%. There are now 160,000 more unemployed persons than job openings in the U.S. Okay, this is according, again, to the Department of Labor. The percentage of U.S. workers quitting their jobs has moved down to 1.8%. That's the lowest since May of 2020. Generally speaking, people don't quit their jobs voluntarily unless they feel really confident that they can find a new job, right? However, cooling labor is not the same as recessionary labor, right? In a cooling labor market, companies slow their rates of hiring, where in a recessionary market, right, companies outright fire people. Look at jobless claims, for example. They're hovering near their lowest levels of the year. In a recession, you'd expect to see that number going up significantly. So again, we're in this kind of cooling period, which we hope was kind of exacerbated by the government slowdown, right? Concerns around tariffs. As we get more into 2026, the hope is that we see a rebound there. We'll see. But as it stands, individual finances are in pretty good shape, individual household finances, right? For the most part. We're seeing low debt service, reasonable savings rates, the uptick in delinquency, loan delinquency that we saw from 2022 to 2024. Not seeing any signs that that's gotten worse. It's actually gotten a little bit better based on what we've heard from the major banks. The other thing is expect a fair amount of stimulus, and I've talked about this in previous podcasts, but we have a fair amount of stimulus coming our way here over the next few months. One, of course, is the sort of delayed impact of the tax bill, right? Because a lot of that did not really help anybody up front, but it will help people in terms of tax refunds, with bigger deductions. So that should be a pretty big wave of stimulus. Also, of course, helps corporations in the way that they can expense certain things. And then, of course, we have a Fed that kind of on the down low has become a lot more accommodative. Not only have they cut rates, but they went from shrinking the balance sheet to now actually expanding the balance sheet again. So we're not quite back into quantitative easing per se, but certainly more stimulative than we were just a few months ago. That combination is pretty powerful, okay, pretty darn powerful. Now, again, there's a lot to contend with. We all know that the tariff policy will continue to evolve through, the Trump administration wrangling with judicial overview and, of course, Supreme Court decision and reaction to Supreme Court decisions. We also know that, of course, Powell's term expires roughly, I think, 100 days from now. So there's a lot of concern about what the new Fed policy could be, and of course, the geopolitics that I mentioned earlier in Venezuela and elsewhere. So a lot to contend with in terms of news flow, but, I'm always a fan of kind of weighing the evidence. The evidence suggests that the economy should be okay. And I think, as Strategas noted this week, one thing to sort of keep in mind is recessions are generally characterized by a contagion that spreads across the country. And there's kind of two truisms here. One, we have never seen a U.S. recession with corporate profit growth staying positive. Two, recessionary weakness in the U.S. labor market has never occurred in a vacuum. It's always been confirmed by weakness in other areas, particularly business spending. And as far as that latter point goes, we really haven't seen any increasing weakness in business spending. In fact, it's been the opposite. CapEx on AI and technology in general has actually offset weakness in other areas. And the expectation is that spending, capital spending, could broaden this year into other parts of the economy as there's less uncertainty about trade policy and other things. And as far as profits go, no sign of profits rolling negative, right? If you believe FactSet and consensus estimates, they're calling for 14% plus earnings growth here in 2026. 14%. So, not even close to rolling negative. And by the way, earnings forecasts tend to be a lot more accurate historically than market forecasts. FactSet found, just saw this a couple weeks ago, that since 2000, excluding major financial dislocations, so earnings estimates were not accurate in 2008, for example, financial crisis, or when the dot-com bubble collapsed and we went into recession and then 9/11, those were periods where earnings were not accurate. But barring a major economic downturn or event, earnings estimates have been pretty darn accurate. In fact, the average difference, again, according to FactSet, between the initial estimate at the beginning of the year and reported earnings was less than 1%. So, again, barring a major, I use the term black swan economic event, something we haven't been able to predict or can't predict, if we're going to have double-digit earnings growth, it's kind of hard to be overly bearish on the market, right? Even if valuation levels stay where they are. So even if investors say, you know what, we're not going to pay any more for corporate earnings. We are maxed out here. Just on the strength of earnings alone, that bodes well for positive returns here in 2026. And a lot of that has to do with profit margins at record highs. We're basically running around 19% in terms of operating profit margins, the best we have ever seen in 100 years. And I just read some data, literally as I was just about to record today. Productivity figure for December came out. It was a good 1.5 percentage points over expectations, up to 5%. That means companies are getting more in terms of productivity from the average worker, is essentially what that means, getting more from less. So that may not bode well for hiring, to be honest, but it certainly bodes well for bottom line efficiency and bottom line earnings. And I think these elevated profit margins are key to absorbing economic shocks from other areas, right? So that is, I don't know if it's a bullish outlook, but it's a supportive outlook. That's the way I would put it. As far as the markets themselves go, even though things started to turn a little bit in the fourth quarter, we still reached some pretty extreme levels of divergence. Okay, so if you look at last year, we wrapped up a 3-year period where the S&P 500 index, this is from FactSet, by the way, 3-year period where the S&P 500 index outperformed the S&P equal weighted index by 34%. Okay, remember that distinction. The S&P 500 is market cap weighted. The bigger the company, the NVIDIAs, the Apples of the world, the bigger the influence. The equal weight, by definition, is each of the 500 companies is worth the same, has the same weight. So the latter, the equal weight, tends to be more reflective of what the broad market is doing. Okay. But again, the S&P market cap, dominated by tech, dominated by the Magnificent Seven, 34% better over the past 3 years. That's the widest 3-year performance gap ever recorded. Also, U.S. large caps outperformed U.S. small caps by 5% last year. That's the 5th straight year of outperformance. That's the longest streak of large cap outperformance ever. One more, growth stocks outperformed value stocks by 3%. That's their 3rd straight year of growth stock outperformance and a record 8th year of outperformance in the past 9 years. The ratio of growth to value has now surpassed what we saw at the peak of the dot-com bubble in March of 2000. So some pretty extreme, continued extreme dislocation in the sense that large growth stocks, primarily tech stocks, have crushed everything else. But we've seen how the worm can turn, right? I could have said something similar about international a year ago, U.S. versus international. Well, guess what? International had a great year in 2025, their best year relative to the S&P in over a decade. It would not be a surprise when you see these levels of dislocation if things go the other way. Well, guess what? Starting in the 4th quarter, that started to happen. Look at financials. Financial stocks hit all-time highs. In fact, the S&P 500 Financials Index, highest level of all time, just in December, and for 6 consecutive quarters of positive returns. I even looked at Bank of America, by the way, just as an example, finally got back to a new all-time high after 20 years. Took 20 years to get back to a new high after collapsing during the financial crisis. Pretty unbelievable. Cyclical stocks in general started to do a lot better. Materials broke out to new highs. Industrials, new highs. And the value index. Who's in the value index? Materials, industrials, financial stocks also broke to a new high. Meanwhile, the growth index did not. Even within the Magnificent Seven, right? Only 2 of the 7 Magnificent Seven stocks actually outperformed the S&P last year. So that's not to say that, tech and growth didn't do well, but even within the large cap, kind of tech and communications names, you're starting to see some divergence. What am I getting at, folks? You may be starting to see some character change. We may be moving into an environment where diversification matters a little bit more, selectivity matters a little bit more. Maybe you can't just go out and buy the Mag 7 or just go out and buy AI. You have to pay attention to valuation, pay attention to fundamentals. I've espoused this before, and quite frankly, the last few years, you did just fine just being in the Vanguard S&P, or I shouldn't say Vanguard, I'd say to any S&P 500 fund. Okay, so keep that in mind going forward, that bears watching, that maybe value starts to do better. Maybe there's room for small caps to start doing a little bit better. I haven't even mentioned bonds that had their best year in a long time. Remember, bonds were in the midst of their longest drawdown. Well, at least going back to the Andrew Jackson administration, if you remember your history books. The Fed was raising rates coming out of COVID. Bonds collapsed. Bonds were up roughly 6-7% last year. So maybe we're in an environment where portfolio balance, which is something we always talk about, starts to be more meaningful, not only in terms of achieving return, but also managing risk. Stay tuned on that. We'll obviously keep you informed. It's only the 2nd week in January, so things can obviously change. But until next time, as always, I wish you wise investing.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the WISE Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.